market maker models. I know you have seen the term ICT market maker models being thrown around on YouTube. And I have gotten all the questions. What is a market maker model? What time does this occur? How do you anticipate a market maker model? And how do you know when a market maker model will fail? Well, in this video, I'm going to be answering all the questions, so stay tuned. Alright. What is an ICT market maker model? An ICT market maker model is a set of rules and instructions that help you determine when a smart money reversal is going to occur. A market maker model will help you understand bias and narrative of the. We're going to jump right into what time do market maker models occur. The best time for market maker model of the smart money reversal occurs from 9:30 a.m. Eastern Time to 10:30 a.m. Eastern Time. That will be the best times for you to anticipate a smart money reversal. Why do I say this? Well, I say this for two reasons. If you go back in your charts, if you are bullish or bearish for the day, the low of the day on a bullish day is formed between 9:30 a.m. and 10:30 a.m. If the low on the bullish day has already been formed during London, wait for the opening bell by 9:30 and you will see another market maker buy model form for you to target buy side liquidity. Now on this chart, you can see that we are clearly bullish. So let's say I mark out this is the high. As you can see on the daily chart, we are clearly bullish. So let's drop down. In the 1 hour, we are clearly bullish. But what I wanted to show you is that if you go back in your charts, you will see that the smart money reversal, as I said, occurs from 9:30 a.m. till 10:30 a.m. Eastern Time. Or there will be a continuation if London formed the low. So let's skip through this. So as you can see, I already said I'm clearly bullish for the day. Okay. Let's drop down. I know you guys will say I am cherry picking this, but I promise you, if you go back right into your chart, you will see the same thing repeat over and over again. So, what did you notice? Before 9:30 a.m., price was just dropping down. When 9:30 a.m. reached, what do you see? Displacement, and it just kept on going higher. So what does that tell you about a market maker model? That a market maker model, when the time is right, you should expect a small money reversal. I know you guys would think I'm cherry picking this, but if you go back into your charts, you'll see this repeating over and over. So yes, so time is crucial. Time is very crucial. And as you can see, price was just running. If I continue to play this back on the 50-minute time frame, you will see how price from there ran to our TP. Yes, you would have incurred a drawdown here. What I'm trying to say, if you have your time correct, your time is good, you should expect a smart money reversal to happen. So the second example I want to give, this one occurred on the 30th of April 2025. This was a very good example because it first gave a judo swing before the small money reversal happened. So yeah, let me just drop down to the 1 minute and show you something. So this was previous day's high. So all this before 9:30 was just a judo swing. This is the market structure shift. This is not. This is. Then we anticipate the buy. Look how this price just went up from there. So yeah. So yeah, this is what I'm just trying to tell you. It's not always, you won't always be right, but if you follow the rules I'm giving you, you're going to see an improvement in your win rate, in your performance. Because I said between 9:30 to 10:30 that you should expect the smart money reversal. So this was before 10:30. So that is what I'm just saying. So yeah, last example. So as you can see, this was the previous daily high that I was targeting. So let me just drop down a bit. So the small money reversal already happened during London. Okay, but you can still be able to still anticipate price running to previous day's high. Let me show you how. So as I said, the most crucial thing about market maker models is time. It is time. So you have to understand that even though you miss this memory reversal here, you can still wait and wait for 9:30 time. And what are we looking for? Displacement. Displacement. If you miss this run, as you see this retracement and the displacement higher, this is an order block with a fair value gap. You're going to take a buy here. You see, but this would have been harder to enter. But this is just an example. I'm just trying to show you that, oh, even though you have missed the small money reversal during London, that you can still get in because market make models is a time-based type of strategy. You get me? So you just have to be aware of that fact. So let's go into the third one. How do you anticipate a market maker model? A market maker model requires a three-stage delivery. The first stage being the original consolidation, followed by a first stage accumulation, then a second stage reaccumulation. When this criteria has been met is when you can anticipate your smart money reversal. Well, this part is going to be confusing to you guys at first, but when you get used to it, you can be able to understand when the first stage accumulation and reaccumulation would form and how they would form. Okay, as you can see this here, this was the first stage original consolidation during London. Then, what happened? It left the box here, came back, displaced through here, came, displaced here, retraced, displaced. So all these displacements is telling you that he already done a first stage accumulation. I don't know if you get where I'm coming from. So it's going to be hard for you at first, because normally sometimes I can call here an accumulation because they are displacing. When you come with experience, you understand how to differentiate them. So this is the second stage here, accumulating, displaced through. For when I see a small money reversal. So yeah. How to know when a market maker model will fail? I want you guys to understand that every system has losses, but there are ways to mitigate unnecessary losses. The first one is displacement. Displacement is a key driver that will ensure you that the market is ready to change gears. Even ICT has said this. Displacement is telling you that the algorithm is ready to go higher to buy side liquidity or sell side. The second one is time. Market maker models happen in different times of the day. It could be London, lunch, PM session, but the reason why I'm giving you specific times from 9:30 to 10:30 a.m. is for you to reduce the exposure you have in the markets. And those times are specific times that you expect explosive moves in the markets. So yeah, I want to give you guys an example. So this was a low hanging fruit target during the AM session. But why did I lose here? Why did I lose? Okay, as you can see, even though we were expecting a small money reversal, this is not a displacement. This is not a big move. I don't think you get where I'm coming from. Look at it. Price went down, gave me a market structure shift here, but the displacement is not what I should have been expecting to see. Well, but today was not really, that day was not really the best of days. I took a loss, but we learn from our lessons. But with time, you'll be able to understand and see the displacements you should trade with and the ones you should avoid. But this is not something I should have been taking. If I should have, I didn't even put my stop loss to break even and just took me out. So yeah, that's it on the tutorial. I hope you guys are enjoying it. Please leave comments on the video, like, share and subscribe. See you soon.